welcome to Morning Markets here at True Potential. Now, yesterday was a federal holiday in the US, thanks to Martin Luther King Day, so much quieter for markets, thinner liquidity, and not much happening except in Japan. Now, you'll see on your screens that Japan had a poor day. It's actually got back most of that overnight, recovered that price drop through the early hours of Tuesday. And that's really to do with market worries about the central bank policy from the Bank of Japan with regards to their yield curve control. You'll be aware of rising yields through last year in most bond markets, except Japan. That's because the Bank of Japan there tried to cap the yields in the bond market there, but that's coming under pressure due to domestic inflation and also much higher yields globally elsewhere. So we'll keep you updated on the Japanese market when we next hear from the Bank of Japan. Now, over the last week or so, we've spoken to you mostly about the US, starting with the strong jobs data at the start of the month, and then the negative print month on month for the month of December for US inflation. And that's helped develop this disinflation narrative, mainly in the US, helped support asset prices, particularly stock markets, through the start of the year. But we've also seen bond yields on longer dated bonds begin to fall as they price in this disinflation narrative. This is the idea that inflation will fall quickly from this peak as base effects wash out. So that was the US, but what about the UK? Well, next week we'll speak to you about UK inflation for the month of December. But let's start with UK jobs data, which was published at 7 a.m. this morning. Now, the headline metrics indicate a jobs market which continues to be very strong. The unemployment rate remains near 40-year lows, around 3.7%. But what will be of most interest to the Bank of England is the measure for wage inflation. And that rose beyond market expectations to 6.4% and is now rising towards that COVID peak when the labour market was distorted by furlough. But the main point here would be that this measure of wage inflation is still much too high and going in the wrong direction to make the Bank of England comfortable. So we are likely to see another 50 basis point rise in base rate at the next Bank of England meeting in February. So that is a 0.5 percentage point increase to 4% for the base rate in February is now likely based on the top line strength of the jobs market in the UK. Now, if we delve a bit more into the data, it will help us understand why the jobs market is so tight. Something that's interesting is there's still this jobs gap where we have around about 1.1 million people unemployed, but we also have 1.5 million job openings. And those job openings have existed since the start of last year. And we've not really seen it chipped away at, other than that some of those job openings are now being taken off the shelf. That is, employers are no longer looking for labour. These job openings have rolled over, but we're not seeing people get these jobs. We're seeing some strength in part-time employment. That probably indicates that the services industry is more buoyant than perhaps full-time employed jobs market and perhaps professional jobs. And this perhaps indicates that there is some underlying weakness developing in the UK jobs market. We've seen no increase in full-time employment for the last 8 months, but we're now seeing an uptick in part-time employment. What we've also noticed is that there's been a marked rise in unemployment for youth unemployed. That measure has risen by 2 percentage points over the last 4 months. Now, this might just be a quirk of a large number of graduates who stayed in higher education through COVID, have now graduated in the autumn, entered the jobs market, and are finding that there's not as many full-time professional job openings as they would like. And they're perhaps unwilling to take some of those part-time jobs which mostly are available in the services industry. However, the focus for the Bank of England will be that wage data, because wages growing at 6.4% per annum is not consistent with inflation at 2%. However, that leads us on to the Bank of England Governor, Andrew Bailey, who spoke yesterday in front of the Commons Select Committee, and he indicated that he does expect inflation to fall very quickly from the spring, and that's mainly because of base effects from the lack of rising energy prices through the winter. Wholesale gas prices in Europe are now at 1-year lows. We've had a much milder winter so far. European storage levels of natural gas remain at record highs. We've not had that drawdown in inventory, and so gas prices have begun to fall in the wholesale markets, and this really should cap inflation through the rest of the winter. And once these base effects kick in, we should see a substantial decline in these inflation pressures, possibly towards 5% and below by the end of the summer. Now that's still some way off, but the Bank of England are forward looking and are likely to hike in line with market expectations in the short run, but probably won't go beyond 4.5% on base rate once they finish hiking, possibly in May or maybe even in July. So there's much to look forward to in terms of inflation. The jobs market in the UK remains quite strong. Please join us for the rest of the week when the focus will turn to global markets and colleagues will update you then. Thank you.
If you're interested in taking your investing to the next level or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.